Thank you very much for attending today's webinar. This is put on by the Basin CRC in collaboration with Water Research Australia and the Australian Water School. And today's webinar is titled Green Finance Opportunities for Sustainable Murray-Darling Basin Management. The work is exploring green finance trends and investor insights to support sustainable management within the Murray-Darling Basin. So I want to begin today by acknowledging and paying my respects to the traditional owners of the Murray-Darling Basin and all their nations across the basin. And I pay my respect to those traditional owners and acknowledge their deep cultural, social, spiritual, environmental and economic connections to lands and waters. And I pay my respect to elders past, present and emerging. So very quickly, a little bit about the CRC. Some of you are probably quite familiar and have joined these webinars in the past or are involved in the CRC, perhaps some of you not. We're a 10-year Commonwealth government-funded and industry-funded partnership working on water management in the Murray-Darling Basin in Australia. Our vision is to see Australia's irrigation regions become the most productive, resilient and sustainable in the world. And our purpose is to work together to grow value from water in a changing world. We are about 3 years into our 10-year program, so there's still many, many good years ahead for the CRC. If you want to know more about the CRC or be added to our mailing list, there's a QR code which you can click on now or take a photo of and deal with later to sign up to our newsletter and explore our website. Okay, so we have a really good lineup of speakers today. We have 3 presentations. After those, we will have a panel session. And I'll just very quickly introduce you to our speakers. So first up, we'll have Dr. Nicola Thomas, who is at Charles Sturt University. And Nicola is an agricultural and environmental economist, and she works in the areas of climate risk, biodiversity loss, sustainable land use, and decarbonisation. Hello, Nicola. Then we have Associate Professor Nick Pawsey, also at Charles Sturt University. And Nick's interests include environmental economic accounting, water policy and management, green finance, and public sector accounting. And then we'll have a presentation from Amy Basnett. She is the head of programs and environmental markets and standards at an organisation called Eco Markets Australia, which is Australia's first independent environmental markets administrator. So we'll have the 3 presentations from Nicola, Nick and Amy, and then we'll have the panel session in the second half of today, which will involve the presenters being joined by Alex Sass. And Alex is the Senior R&D Program Manager at Wine Australia, and Alex specialises in great quality vineyard management, sustainability and climate resilience R&D. So now, and then there's me, of course, the chair. I'm the program leader at the One Basin CRC and based at Flinders Uni, where I'm a professor of economics. So I now would like to hand to Nicola, who will take us away with the first presentation.
Thanks, Nev, and thanks for the opportunity to present. So I'm going to provide the background of what green finance is and some of the instruments. We're focused on the Murray-Darling Basin, which, as some of you may or may not be aware, it's basically dominated by agricultural land use, with 80% of it used for one form of production or another. So to really come and devise some environmental solutions to improve environmental outcomes across the Murray-Darling Basin, we need to figure out ways to incentivise the agricultural sectors to support those activities. So thinking about the agricultural sector and some of their sorts of, concerns and issues, there's been limited carbon and biodiversity market uptake in the sector. Amy's going to talk about some of the ways that she's hoping to overcome that. We've got, farmers feeling under pressure from increased, ESG reporting, requirements to maintain market access, to continue to export to the EU or to continue to, sell their produce to a particular, organisation which is really focused in on carbon emissions and greenhouse gas reduction, that they're now faced with a whole lot more compliance and reporting requirements. On top of that, we've got floods, we've got fires, we've got drought, we've got everything hitting Australian farmers with, increased climate risks and in this increased, variance, which is creating some really lumpy cash flows for farmers and making it pretty difficult conditions. So on top of that, one of the things they're doing to try and mitigate things is they're trying to really be as efficient as possible with their production processes, getting the biggest bang for their buck that they can have. But we need to think about where are they getting those bucks, those dollars from. So, to overcome those lumpy cash flows that we can have a really great season and then a really poor one. The farmers, traditionally, they typically get finance from a range of different sources. The three main ones are here. So we've got government that can provide, grants, subsidies, incentives. They can be for specific things that then they'll provide that finance to a farmer for undertaking an activity. Another way is that and the most common and traditional way is that farmers can use their farm to then obtain cash flow, a line of credit from the bank. That means that if something goes wrong, they could lose the farm. The other way is more expensive way is they can get that line of credit like a credit card at a much higher repayment rate for any monies borrowed. The third sort of source is that they can get philanthropic money for a range of different philanthropic requirements. They'll give them money for a specific project, or they're these new ones, which we're sort of going to focus in on a bit more, is they're these developing direct investment platforms, digital platforms that are starting to come into play, and green bonds is another sort of potential source. So what is green finance? I hear you saying green finance is basically when the financiers or the banking system will lend you money or provide you money in some way that's tied to a condition. I'm sure you've all heard about, EVs, and maybe some of you have purchased an EV with a hire purchase agreement or obtaining funding from a bank. That's a form of green finance. You're effectively, by buying an EV, you're reducing your carbon emissions, and that aligns with the United Nations Sustainable Development Goals. So that's basically what it is. There's a range of different instruments out there. I'm focused in on the ag sector, so the agricultural sector. We're not really sort of thinking as much about what else is going on there. We've got green and sustainability bonds. So those are basically IOUs, which are issued by larger organizations, so not just you and me, but big organizations for tens to hundreds of millions of dollars. And these are used to fund social, climate, environmental activities. So the green ones are typically things like, okay, how can we reduce our emissions? How can we improve our, sustainability? I'll go into a bit more later. The other way we can do it is discounted leases, green leases. These are when a farmer goes out and sort of leases a parcel of land off someone and they get a discounted payment for instituting a legume in their crop rotation, making sure they retain some vegetation, doing things, fencing it off, whatever else. Another one, carbon credits. I'm not going to go into much detail on that. I hope that you guys are all across carbon credits, only to say that there's voluntary markets as well as regulatory markets. And that's, then the other one that's sort of aligned with that, the developing one, is biodiversity and nature credits. So again, I'm not going to go into much detail because Amy's got a great presentation on that, only to say that there's the regulatory markets in Australia that in early stages, the nature repair market, as well as some voluntary markets, both in Australia and internationally. Next one is green and sustainability linked loans. They're issued by big banks in Australia that are really saying, okay, if you undertake these energy efficient practices, reduce your water consumption, improve your land management practices to increase soil carbon, we will then provide you with a discount off the, the standard loan rate, if you borrow this money for these specific purposes. The last one we sort of looked at was direct investment platforms. This is a new sort of one building on Gen X, Gen Z and millennials that love doing things digitally. And it's digital platforms that can overcome the banking sector, overcome the middleman, and it connects farmers with investors. So it's smaller scale where you and I can then go and say, hey, we'll give you some money to grow that crop. And the farmer's like, great, we'll provide you a share of the profits. So a bit more on that in a sec. So here's an example just pulled out randomly of the NAB green loans. These are what they are for agribusiness. And as you can see, they're really all aligned with emissions reduction across one way or another. So these are the sorts of things that they will provide loan support for practices that decrease emissions through these different sort of ways. The direct financing is a platform that I have no particular, anything to do with, but it's direct financing platform where you can go and provide that money directly to a farmer and they use it. You get the share of the profits. You can then invest in different farms, tomatoes, grapes, crops, whatever else, and curate your own digital farm. So it's really aligned with what millennials love to do. And then we've got the green bond market that we've got. Green bonds are sort of typically aligned with different UN Sustainable Development Goals. Sorry, it's a bit of a hard to read one here, but you can see that they're mainly issued across clean energy, sustainable communities, and responsible production in this particular bond market, which is the International Capital Market Association. If we look at the value of the green bonds globally that have been issued in the past decade or so, we can see that from the largest sector is in land transport, so that's EVs. The next biggest is sort of around in building, residential and commercial building energy efficiency, and then there's some in the solar sector. This tiny slice that I've pulled out, that's 3%, and that's for bioenergy. Agricultural bonds is 1%, so it is a third of that tiny slice globally, and those bonds were issued for irrigation efficiency upgrades in Mexico and Brazil. In Australia, the green bond sector, we have got generally a larger proportion in land transport. So that's all of those EV loans coming out to play. But we've got that massive chunk of land transport. So the banks are getting the finance through bonds and then loaning it out to you at a higher rate. There is some forestry here. And we've got some buildings and commercials, noting that bonds do not have to disclose the value. So this is somewhat understated, the commercial. And then we've got residential buildings, bit of solar there, but not as much as I was actually expecting when I did the analysis. There's no ag bonds issued in Australia at this point in time. So what we've got here is we've got $1.3 trillion annually flowing into green bonds. It is the largest. It is overtaken traditional bonds. It is a massive growing sector. If you've got, finance, or you've got superannuation and you've ticked the box for sustainable investment, you've probably got some green bonds. Of all of that 1.3 trillion, 11%. So 1% ag, 10% forestry. So there is lots and lots of opportunities for green bond investment. It is a scalable alternative that we can have. It's got to be large scale. But then at the other end of the scheme of things, there are digital platforms which can offer a different small scale, personalized mechanism that potentially can support farmers in developing these environmental solutions. However, we don't really know enough at this point in time about investor and landholder preferences. And on that note, I will pass over to my colleague who's been talking to the landholders and investors. Take it away, Nick.
Thanks, Nicola. So as Nicola introduced, our team, backed through the One Basin CRC, has been working to identify new opportunities to use green finance to support investments in sustainable land and irrigation practices across the basin. And as part of our work, we've been working to engage with landholders and green finance stakeholders to understand what types of green finance instruments might be viable and identify what these sources of non-traditional finance might target. and how these instruments might be best designed to be attractive to investors and also to meet the needs of landholders. Thanks, Nicola. So in order to capture the perspectives of investors on green finance opportunities, our team conducted a round of in-depth interviews in the second half of last year. And amongst these stakeholders, we were in particular targeting agri-investment fund managers and sustainability and other investment managers from different nationally and internationally based superannuation and private investment funds. And from these interviews, thanks, Nicola. From the interviews we conducted, it was quite clear that there's as Nicola alluded to and provided some good stats on, there's a significant and growing potential pool of green investment funds from different sources, and across many of the financial stakeholders we spoke to, that there's an interest in being part of the solution to support sustainable land management across the basin. And there was demand in particular for fixed income investment options like green bonds, and as Nicola noted, though, at the moment these green bonds are typically targeting things outside of agriculture. And given this gap, some investors acknowledge there's an opportunity to diversify green bond investments or to rebalance green bond portfolios through an enhanced focus on agriculture. It was clear that much of the interest in green finance at the moment has been taken up by carbon investment opportunities, and this is somewhat understandable given the relatively mature and global nature of these markets. In relation to instruments like biodiversity credits, however, there was a recognition that there's a need to stimulate this market and think further about who the potential end buyer of these credits might be. And in recent times, the move to require emissions reporting within Australia and other parts of the world, and the increased scrutiny on greenwashing has motivated much of the interest in green finance. And certainly the investors we spoke to, they're increasingly aware of the importance of ensuring that any environmental claims they make are evidence backed. And across the interviewees we spoke to, that there was a somewhat of a reluctance to get more involved in green finance at the moment, given some of the global regulatory uncertainty, particularly around carbon markets. And as one interviewee put it, investors tend to get quite cautious about putting their money into schemes which might easily be changed with a simple stroke of a politician's pen. Thanks, Nicola. And whatever green finance instrument we are talking about, whether it's something around water efficiency, carbon, or biodiversity, investors really want to see clear and measurable outcomes. And certainly amongst a lot of the people we spoke to, there was a recognition of the love of infrastructure investment opportunities. And given this desire for measurable outcomes and low risk projects, as one interviewee described it, that there's a need to keep green finance investment opportunities relatively boring with a straightforward story. The need for scale was repeated across the interviewees, and on this front, even a project that might involve an investment of $100 million is often regarded as small. And to build the investor trust in green finance, there was a preference for strict measurement protocols aligned to international standards, so they can have confidence that the schemes they are investing in have evidence-based environmental outcomes. And even though green investment instruments focus on environmental outcomes, investors still require competitive commercial rates of return. And often this is not out of choice, but due to the strict investment regulations that require fund managers to act in the best interest of their investors and to optimize the financial returns. And given these considerations, some suggested that the initial focus might be on blended approaches where we're connecting landholders with corporates, philanthropic sources, banks, and other financial market participants, and also there's a potential role for government to underwrite these schemes to build the confidence across investors. But overall, though, many of the interviewees we spoke to identified a general lack of understanding of environmental risks and the nature of sustainable land and irrigation practices across the basin, and so there's accordingly a need to raise the awareness of the nature of corporate agricultural related risks and how these risks might be managed through different sustainable practices. Thanks, Nicola. And so putting it all together in terms of what the market is saying, so clearly there's an opportunity to expand green finance beyond the narrow focus on carbon and potentially stack carbon benefits with other environmental outcomes. There's a need to stimulate the demand for instruments like biodiversity credits. Whatever we do, we've got to clearly measure the outcomes, put in efforts to design appropriate measurement protocols, and ensure that whatever we're doing, that there is a commercial rate of return. There's certainly opportunities in the infrastructure space. Blended financial approaches appear to be a good first stage, and there's on the positive side, it's great to see the growing interest from investors in how they can support environmental outcomes and Murray-Darling Basin communities. Thanks, Nicola. And beyond talking with the financial market stakeholders, we in the second half of last year, we also completed a round of in-depth interviews with landholders across the basin. So we completed interviews with close to 20 landholders, and we sought to understand from their perspective what would actually help them to continue to invest in sustainable land and irrigation practices, and from their perspective, what kinds of green finance would actually be useful for them. Thanks, Nicola. And it was clear that many of the landholders are under significant financial pressure from different angles, from rising input prices, unstable commodity prices and demand, and challenging growing conditions. The landholders we spoke to all noted their commitment to manage their water use as efficiently as possible, and noted their commitment to adopt a range of different sustainable practices, from drip irrigation, cover crops, crop rotation, and some noted their efforts to restore riparian zones on their property. So at present, though, a lot of the landholders we spoke to felt there was a limited recognition of their efforts to implement sustainable practices on their properties outside of the farming community, and most of these past investments in sustainability have been funded through either the landholders' own equity or grants where possible. But when it came to discussion of grants and subsidies, often these can be viewed in a negative light, and as some landholders suggest, I can't pay for it myself, I won't do it. And when it comes to available grants and subsidies at the moment, some landholders note, it's difficult for us to apply for these grants given the time involved and the information I have to capture to complete the application. So in relation to practices which reduce a farm's emissions intensity, some question whether it's possible to further reduce their intensity given the practices they've already put in place. Their limited ability, for instance, to be able to return solar power to the grid, as in many places the grid's already maxed out and can't handle any more power getting fed in. Some question whether they might be able to use things like battery-powered machinery given the energy requirements of their farming operations. And as with the financial market participants we spoke to, many landholders noted how their interest in carbon markets is held back by the regulatory uncertainty, and they're unsure what the requirements would be in the future, and worried about also what the international market expectations would be. And across many of the landholders, there was a general lack of awareness of instruments like biodiversity credits and what they involve. Thanks, Nicola. And in relation to other sources of green finance, like sustainability linked loans, many were unaware of what's involved in these loans. And some pointed to the lack of local banking contacts as being a reason why they're not necessarily aware of these developments. Some question whether or not the discount is a real discount and whether they might be able to get that discount if they shop around anyway. A lot of farmers noted that it's not really much of a use for them to be taking on any more debt in any case, and worried about the extra requirements if they participate in these loans. And similarly, and further in relation to the carbon credits, many noted a general lack of knowledge of what's involved in these projects, and a lot were hesitant to engage in the practice of carbon offset, given the belief that they need to hold on to those carbon credits, inset them to meet their future reporting requirements. Thanks, Nicola. And so given the apparent interest from green investors for large-scale infrastructure projects with measurable outcomes, we're interested to further explore opportunities to use green bonds to support infrastructure investments across the basin. So how, for instance, might irrigation utilities utilize these as a source of finance, and how it might support them to deliver lower prices to their customers, with their charges often being tied to the cost of debt. And clearly there's a lot of interest in biodiversity credits and demand to build confidence in these schemes and the outcomes. And now we have the opportunity here from Amy Basin from Eco Markets Australia to tell us a bit more about their work in the nature credit market space and the efforts to activate the market and promote methodologies to account for environmental outcomes and measure the outcomes of environmental and management strategies in a rigorous manner. But I'll hand you all over to Amy now. Thank you.
Thank you so much for having me today and the opportunity to talk to you about environmental markets. That was a great introduction. Thank you. So who are we? Eco Markets Australia. We are an independent, not-for-profit administrator of voluntary nature markets. We work in natural capital credits. So we've been around since 2020. Our founding members were Terrain NRM, Inky Dry Tropics, Queensland Government and Green Collar. After the Reef Credit Scheme was written, it was identified that there was a real need for an independent administrator that really informs the integrity of the market and sends clear signals to investors that it's high integrity and managed independently from those writing methodologies and conducting projects themselves. So what are natural capital credits? Credits are issued for measurable nature improvements that have been achieved. We don't issue credits unless the outcome has already been achieved, quantified and verified according to an approved methodology. Credits can be sold to companies under ESG and offset schemes. And the Envo mark, which we launched last year, is a mark of assured integrity, and it represents the scientific rigor, data transparency and integrity associated with the delivery of that credit. And I'll talk a bit more about that shortly. So credits accumulate over a defined period and can be sold separately or aggregated. We've done a bit of work to ensure that we align with international best practice, such as those on the side, and I'll talk a bit to some of those examples later. And this ensures that our reef credits can be seen as a global financial market mechanism. So this is the Envo mark assured integrity. So if you start to see this, you now know where it's come from. This now stands before all of our credits. So it's an Envo mark reef credit, a cassowary, an Envo mark reef credit. And this is really just as I said, signal to the market, high integrity. And what does that stand on? So that's on our value nature framework, and this is the process that sits behind that. So as Eco Markets, we have a technical advisory committee chaired by Bob Spears. We've got the likes of Jane Waterhouse, Kim Whiteoak, Ian Prosser, Dave Pennell, Lynn Turner and Michelle Burford, some amazing, really well-respected leaders in their field. They provide a scientific rigour and oversight to any standard which is developed or methodology which goes through our approval process. So eco-markets can write the standard, but methodologies are externally developed by those with the skill sets. It goes through peer review and public consultation once it hits our desk. The Technical Advisory Committee provides that oversight and recommendation, and then the Eco-Markets Australia Skills-Based Board gives the final approval. So then a project can be validated underneath one of those approved methods for on-ground activities where landholders and proponents implement environmental outcomes with regular monitoring verified by third parties. Once that has happened over a monitoring period, credits are issued once they've been quantified and verified by a third party and listed on our registry. So what do we see as the nature credit demand drivers? Well, obviously there's the regulatory side, which has been addressed today, and we are the carrot, I suppose, the voluntary credit users. So obviously ESG has been discussed. There is a corporate responsibility as well that has come into play, where people want a competitive advantage over the others in the industry. And obviously it goes right down to expected offsets and mandatory credits through the likes of carbon. Eco-markets doesn't work in carbon or voluntary carbon. We focus on biodiversity and water improvement. So I wanted to give a really brief update on the Reef Credit Scheme, which is our inaugural primary and most known market so far. The Reef Credit Scheme has been going for several years, and over the last 4 years, we've seen 3.2 million invested back into reef credit projects. This goes primarily to the proponents and landowners. So EMA takes a clip of the ticket, but the exciting outcome of this is that this only marks the first 4 to 6 years of projects which are currently registered on our system. And there is still another 15 million estimated in potential revenue from credits still to be seen over the rest of that project lifetime. This has to date equated in over 65 tonnes of dissolved inorganic nitrogen prevented from entering the Great Barrier Reef. And we've got 5 methodologies, including dissolved inorganic nitrogen in our nitrogen use efficiency fertiliser management method, sediment covered by our gully and grazing land management, and wastewater. This is the Burdekin wastewater treatment plant, which uses a macroalgal bioremediation method, and we're expecting credit issuance from that in this year, hopefully. So it'll be interesting to see what impact they will have on the market. What will the pricing and the demand be for those? So and I suppose I should make the comment that this data is based on our nitrogen use efficiency method alone. And we've seen 99.3% of credits purchased to date by corporates and non-government in the likes of Qantas, Rio Tinto, HSBC, Sydney Opera House, Terrain and Queensland Government. What is exciting is the Australian government endorsed reef credits as an offset for sediment in the Great Barrier Reef last year with our Bowen River Gully Rehab project. This really just signals federal government endorsement, and it will now play the part of a setting a precedent that there's other opportunities coming through as more projects come online. And the estimated number of credits for this project is 1,394 per year, equating to 750 tonnes per year of quantified and verified fine sediment. The Reef Credit Scheme itself is based on the Reef Plan 2050 and focuses purely on DIN and fine sediment. From the success of that program, we've now developed the Australasian Catchment Water Improvement Standard, released last year. This takes the framework of REAP, but calls on regional water improvement plans and comparable strategies to set the defined targets, set the defined catchment settings, the in-scope activities, which are supported by science and government initiatives. So this is now available nationwide, and we are talking to several governments and industry and federal and state about how we might be able to scale water improvement throughout Australasia. Grazing land management methodology, which is approved under REEF, has just been revised to fall under this standard. This will go to public consultation hopefully in the next couple of weeks, and would be, once it's gone through peer review, public consultation, hopefully approval, would be the first methodology applicable throughout Australia, including the Murray-Darling Basin. So this is just a bit of a vision into what we're hoping to achieve. This Eco Markets is looking at a Moreton Bay credit. What can we do in southeast Queensland as an Olympic city? What can we do in the Murray-Darling Basin? So we're talking to federal, state and industry about what is the appetite and what would it look like to create a water improvement pilot in the basin. And if there's anyone that wants to talk to us further about that or participate, please let me know after the meeting. We're keen to chat. We're also talking to Western Australia and also, swimming the Yarra. What are the opportunities that we can take from the learnings of Reef and apply this outside the Great Barrier Reef catchments to drive private sector investment into nature repair? Considering there's a $700 billion deficit a year, it's seen as a really great alternative or another option alongside government grants and all these other funding mechanisms that have been discussed today. So looking at the Basin Plan review, one thing that we thought was there are really potential methodologies associated with the findings. Floodplain connectivity, non-native fish population control, the Menindee Lakes restoration needs, general pollutants. There was talk about the groundwater aquifer recharge and also water security for townships. So we don't write the methods, but we have written the framework and provide the governance that can enable the delivery of such methods at a project scale throughout the basin. So, so we're just looking for opportunities to support such work. So what does the market need? It needs participants, methodology developers, project proponents, third-party verifiers, buyers, and the regulator in terms of offsets. And how can you activate a market? So this was a concept by our CEO, Goswick Shephers. How can you activate a market through a not-for-profit impact-only fund? So the idea behind this is that you bring government grants, corporate support, philanthropic donations into a central fund administered by Eco Markets Australia, separate to our secretariat to ensure integrity and independence. But you would then share in the profit of those credits sold. And then that portion of profits would go back into the fund, making it evergreen and directed for project capex. So the intent of this is to scale projects and scale impact. So our vision is stacking. So we've spoken to the Clean Energy Regulator about stacking our cassowary credit biodiversity program through the rainforest replanting methodology with carbon, particularly the EP mallee planting method. We've also spoken about stacking at the soil carbon methodology with grazing land management, and both have been approved by the Clean Energy Regulator to do so. But we see this as an opportunity for further diversifying income to enable co-investment by private sector into projects on ground. So if there is a biodiversity, water, and carbon benefit from a project, well, this should be able to be unbundled and sold to even separate investors to drive that project. And I suppose this is just something that we're working towards and our framework should support. Lastly, I wanted to just let everyone know that we're also developing a biodiversity improvement standard. This will go to public consultation in the following months, hopefully by May. The idea here is, as has been discussed today, there's a clear need for quantifying the co-benefits to projects such as in the carbon world. There is a biodiversity improvement that is held, but we're looking to reward the achieved and maintained condition of target biodiversity assets. We also want to align it with government initiatives, though. So this is currently being explored by our Technical Advisory Committee. So the nature repair market obviously has a biodiversity certificate issued at year 5. And how can we align our market and align this standard to benefit that? Obviously, we work in credits. which is a rolling credit. So you can have a monitoring period on an annual, yearly, quarterly, rotation. So they serve different purposes, where a nature repair market certificate seems to really drive that quantification of the co-benefit, and then you can get great premium on carbon. This is a slightly different approach where it's credited. So it will be interesting to see what our TAC comes through with, even with the EPPC Act reforms, the offset funds which are out there. How can this be of value to existing initiatives? And I suppose at that, I'll say thank you very much. And I'll stop sharing and hand back to Neville.
Great. Thanks, Amy. And thanks for all the presenters, Nick and Nicola as well. Some really fascinating talks. And I've been keeping an eye on the Q&A function. There are some great questions coming through, which I'll pick up in a second. But I certainly want Alex to have a chance to speak. He's on the panel and hasn't spoken yet. And so I might actually take Gavin's first question and address that to Alex, whether he is aware of, whether Alex is aware of, within the green finance, green bond system, any products available that might be more focused on the operating expenditure compared to, say, capital expenditure, which seems to be typical within the finance sector.
Neville, I was going to handball that one to Nick and Nicola because I know that they looked at those various opportunities in their great review.
No worries, Alex. Good handball. Who wants to take that, Nick or Nicola?
I can have a bit of a start, and then Nick can fill in any gaps. So they can be for operating expenditure. There certainly is bonds and there is activities and potential for things out there. It's just that typically we certainly have more around the capital expenditure at this point in time. So that it's really not limited. There is definitely opportunities, but from my understanding, currently there's more capital going towards CapEx type stuff.
Nick?
And yeah, certainly a good point. When we're thinking about finance, as with any finance, if it's green finance, we've got to make sure the source of finance, the requirements of that finance match the end use of that finance. So obviously things like bonds and sustainability linked loans are great for big upfront investments in capital. But certainly there's also an opportunity to explore, for instance, how we might better work with input suppliers to offer discounts for activities that deliver shorter term outcomes.
One other interesting question here from Rhonda. Is it Rhonda? Yeah. What impacts will these credits or other sort of green tools have on existing mortgages or security products from the traditional lending sector? Will some of these newer green tools create more risk and increase or decline in security around value and property rights? I want to have a go at that one.
Yeah, I can have a go. So some of these green agribusiness loans, they're effectively stacked on top of your existing mortgage or, equity, loan holding. So when they're assessing it, they're sort of going, okay, there's encouragement for some of the banks to roll over your entire product into some of these green one, or it can be, okay, this is an additional loan on top of your existing, finance, and it's going to get a different one. Some of them sort of say, okay, because you're doing this activity, we'll give you a discount across the whole loan. And some go, well, for this additional sum of money, you get a discount. So it's basically like when you go out and you want to borrow some money for something additional, they're going to look at your total ability to service that loan based on the existing debt you have.
Great. Thanks, Nicola. And now I also understand that Alex might have a question for Amy.
Yeah, thanks, Dill, and thank you, Amy, for that great presentation. In my role, I work closely with wine grape producers around Australia, and typically they're on the smaller scale. So I'm very interested in the concept of aggregation and coming together as like a community group and accessing some of this finance? Because as we saw in some of the chats, sustainability-linked loans, we're talking about tens or hundreds of millions of dollars. And a point that Nick earlier raised around scale is very real. When we did the interviews with the investor groups and the financiers, they were talking of those, quantums in the hundreds of millions. You also, just like Nick, mentioned the need to have measurable outcomes, the measurements being very important. So I wondered, what's your take on bringing together groups within catchments, for example, to be able to access some of these finance instruments that Nicola and Nick have mentioned?
Well, I can mainly speak to credits that we work in and the markets and the schemes. To date, we haven't had aggregation occur in terms of aggregation of projects and landowners, purely because of the complexity involved. Someone would have to manage the credit issuance and relationship, who owns the credits, the amount of credits, all that would need to be managed by someone. And generally that would fall on the project proponent who has developed that project application. So I think it would be something we'd be keen to work through and enable for sure, because there are real opportunities for scaling across, a larger landscape level by aggregating projects. I think it's a no-brainer. I think there's just some challenges that we'd have to work through on how to manage that credit ownership, and then through the registry, allocation of profits, etc. That would be complicated.
And if I could, Neville, just further to that, the range of projects you're doing sounds great, but they tend to be in areas that I think I would associate as being quite sexy or quite popular, for the Australian context. And I think because of that, you've probably succeeded in getting certain investors to buy the credits. What do you think the scope is to move from those regions that you're active in into other regions that within the Murray-Darling Basin that may not be on the radar of some of those philanthropic investors?
The way that we approach it is, with a market, you need an icon. To be able to make it sellable, there has to be something which attracts an investor, because what they are buying is the right to claim the environmental outcome. So what are they claiming? It's in reef, it's a kilogram of DIN reduction or 538 kilograms of fine sediment reduction prevented from entering the Great Barrier Reef. The same would go to the Murray-Darling Basin. The Murray-Darling Basin is huge, and it is a large catchment area. The Great Barrier Reef catchments is a very large area. There are some places that might fall outside that defined catchment, but it is a significant space. So it's the issue then that you face is the attenuation of that pollutant from the farm gate to the asset of concern. So with the Murray-Darling Basin, part of what we're trying to work out is, and why we're considering a pilot, is that the attenuation to what, because if you're a long way away, that means less of the pollution actually makes it to that asset, and therefore it's less credit issuance, because what you're getting is the actual amount that impacts that environmental asset. So I think that in terms of the Murray-Darling Basin, what we're talking about is the entire region, but we're focusing at the moment on a pilot to demonstrate its application, interest, and then to drive the investor, proof in the pudding, I suppose.
Thanks, Alex. Thanks, Amy. Okay, there's a few other questions still in the Q&A that we haven't touched on yet. There's an interesting one here also from Gavin, which is directed to Amy, which is whether the projects that your organisation typically supports or develops are initiated by your company, the public sector, or the private sector. So, yeah, where's the initiation of a lot of these projects?
Again, to date, under the Reef Credit Scheme, it comes from the third-party project proponents, such as your green collars or your AgriProves, your Viterras, who are out on ground working with farmers to seek projects. Obviously, feasibility is a big thing, making sure that credit issuance and price per credit, which we're seeing at the moment in reef is between $150 and $175 per credit, is sufficient for that, for the capex, I suppose. We're expecting the cost of sediment credits under gully will be more than that, because obviously the earthworks and the capex involved is far greater. So the market kind of costing will shift based on the method and then the demand as well. So in terms of whether it's coming through private, public or eco markets, we're happy to support and direct inquiries to proponents, because the methodologies are, there is a bit of support needed for farmers in delivery. There's, maintenance, monitoring and third-party verification by the likes of, GHD or ERM, etc. So EMA tries very hard to remain independent as the market administrator so that we do the project validation, and hence why we don't find those projects.
Yeah, no, that's good. Thanks, Amy. I've got there's still a couple of questions in the chat, in the Q&A, but I've got perhaps an interesting question maybe for Nick or Nicola after their interviews with, landowners. And I think Nick made the point that there is an information shortage out there, which is, I guess, prohibiting, farmers from getting involved or seeking green finance. Now, there is a lot of research on the economic benefits of investing in sustainable land management, whether it's soil improvement activities or revegetation and shading for livestock, et cetera, et cetera. There's a lot of research out there. Is it that this information on economic benefits is just not getting out to the wider communities? It's stuck in journals and needs to be communicated better.
Yeah, and also there's often a perception that there is a lot of evidence on the economic outcomes of sustainable land management practices, but often the research tends to focus on the environmental outcomes or the soil health outcomes. It doesn't necessarily do a full economic assessment at the farm level whether or not the practice is available, is profitable. But certainly there's a need for us as researchers to better communicate those profitability outcomes of the sustainable practices that researchers are exploring, and certainly a need to connect researchers with landholders.
All right, well, that's a job definitely for the CRC and for the research teams that we work with. All right.
And also it's important for researchers themselves to, understand what is a relevant financial metric for a landholder. What kinds of costs and benefits are relevant, and what profitability measures are the kinds of things that drive farm business decisions.
Yep. Cool. Anyone else want to comment on that as well? No? All right. We've only got a couple minutes left. There's one interesting question from Arazu in the Q&A. And this is around water corporations, in infrastructure operators and the like, particularly in the Murray-Darling Basin. Can they benefit from carbon reduction through green finance? Or could they? Nicola or Nick or Alex or Amy want to take a stab at that one?
Yeah, I'm happy to take the initial attempt, and certainly it's something we're interested in exploring further. And there's a related project through the One Basin CRC focused on decarbonisation of basin activities, and that's a project that I would encourage you to follow up with. But certainly it'd be interesting to follow up on whether or not water utilities are actively involved in carbon credit projects through the ACCU scheme, and certainly we're interested to explore whether or not green bonds might be an alternate source of finance to support capital investment by these utilities, given the clear environmental outcomes from the works that they're undertaking, and we're talking about projects at significant scale.
Thanks, Nick. Now, we are about to run out of time, and unfortunately there are a number of questions still in the Q&A that we haven't got to. So I thank you for posting those questions, and we might actually, as a team, share them out and perhaps try to answer. So bear with us. We'll do our best to get answers back. I just want to thank you all for attending. As I said at the beginning, a recording of this webinar will be emailed to you and uploaded to the AWS website and YouTube channel. You'll also receive a certificate of attendance within the next couple of business days, which can count towards your CPD. There's a QR code there. Please scan that, and I believe that'll take you to a survey. And then we'll hope to see many of you at the next One Basin CRC webinar on the 1st of April, which is all about storing water for the future and water banking in the Murray-Darling Basin, which is a project that the CRC is working hard on. So thank you all again.